BigBear.ai is currently trading at $5.39, a significant surge of nearly 6% in today's session. And while many watching this momentum on their Robinhood or SoFi Invest apps might see a classic AI growth story in the making, a stock ready to follow the meteoric paths of an NVIDIA stock or even a Tesla stock, they are likely overlooking a critical and dangerous divergence between the market narrative and the company's operational reality. The expectation is a nimble, high-growth AI powerhouse ready to capture lucrative government and commercial contracts. The reality, buried in their latest earnings report and reflected in the cautious positioning of institutional clients at firms like Fidelity and Interactive Brokers, is a company grappling with significant revenue declines, missed analyst expectations, and a business model that is far more challenging to scale than the popular story suggests. This isn't just another ticker symbol in the AI gold rush. It's a complex case study in the tension between futuristic promise and present-day performance, and understanding this gap is paramount. The common belief, the one that fuels intraday rallies like the one we are seeing today, is that BigBear.ai is a smaller, more agile version of Palantir, a company positioned to leverage its artificial intelligence and machine learning platforms for the defense, intelligence, and, increasingly, the commercial sectors. The narrative is compelling: a company with deep government ties, a growing backlog of contracts, and a name that perfectly captures the zeitgeist of the current market. Investors engaged in self-investing see a sub-$10 stock in the hottest sector on the planet and envision a multi-bagger return, a ground floor opportunity. They see press releases about partnerships with the Washington Commanders or accelerating airport arrivals at Nashville International and equate it to sustainable, scalable growth. They hear AI and national security, and they see a moat, a surefire bet on the future of data-driven decision-making. This expectation is powerful, and it's what drives the high-volume spikes and makes BBai a frequent topic of conversation on various online investing sites. However, a more sober analysis, the kind performed within the walls of Fidelity Wealth Management or by quants using the sophisticated tools of Interactive Brokers, paints a starkly different picture. The reality is that BigBear.ai's recent performance has been deeply troubling. The second quarter 2025 earnings report was not just a slight miss, it was a significant disappointment. The company reported a staggering loss of 71 cents per share, wildly missing the consensus estimate of a 0.06 loss. Revenue also fell sharply by 18% year-over-year to $32.5 million, coming in well below the $41.1 million analysts had projected. The company attributed this decline primarily to disruptions and lower volume on certain key Army programs. This immediately challenges the narrative of a stable, government-backed growth trajectory. While a competitor like Palantir has been reporting accelerating growth in its government segment, BigBear.ai is reporting a contraction. This isn't a minor deviation from the script, it's a fundamental plot twist that most retail investors seem to be ignoring amidst today's positive price action. Let's dissect the recent stock movement with this context in mind. Today's 6% jump is occurring on significant volume, which suggests a degree of conviction. But conviction in what? It appears to be conviction in the story, not the numbers. The stock has been incredibly volatile over the past year, trading in a massive range between 136 and 1036. This kind of volatility is a hallmark of a speculative asset, where narrative battles with fundamentals on a daily basis. Institutional ownership, while present, shows a mixed bag. Filings reveal major players like Vanguard and BlackRock hold positions, but the percentage of the float held by institutions is not as dominant as one might find in a more established company. Furthermore, the analyst consensus, while leaning towards a buy, has seen price targets revised, reflecting the uncertainty introduced by the recent earnings miss. The bulls will point to a substantial backlog of $380 million as of the end of the second quarter. In isolation, this number seems impressive, but a backlog is only valuable if it can be converted into revenue efficiently and profitably. BigBear's gross margins, which hover between 25 and 35%, are significantly lower than Palantir's, which are consistently around 80%. This points to a crucial difference in business models. While Palantir has developed scalable platforms like Gotham and Foundry that can be adapted for various clients, BigBear.ai appears to be building more bespoke, custom solutions for each contract. This approach is less efficient, more costly, and inherently harder to scale, capping the company's long-term profitability potential. To be clear, BigBear.ai is a legitimate technology company with valuable intellectual property. They provide critical decision intelligence solutions across three main areas: observe, orient, and dominate. Their platforms are designed to help clients make sense of vast, complex data sets to gain a competitive advantage. For the U.S. government, this means optimizing military readiness, managing supply chains, and enhancing intelligence gathering capabilities. For commercial clients, it can mean improving operational efficiency or securing critical infrastructure. They have announced intriguing projects, from collaborations with Smith's Detection for airport security to launching AI-powered cargo security in Panama. The issue is not the legitimacy of the technology, but the financial viability and growth trajectory of the business model built around it. The company was forced to withdraw its adjusted EBITDA guidance for the year, citing the disruptions in its U.S. Army contracts. This lack of visibility from management is a major red flag and makes it incredibly difficult for investors to build a reliable financial model. While the company holds a strong cash position, which provides a runway, the significant net losses and negative cash flow raise concerns about future dilution if they cannot turn the corner on profitability. Looking toward the future, the outlook for BigBear.ai is precariously balanced. The bull case hinges on several key catalysts. First, a stabilization and re-acceleration of their government contract revenue. If the disruptions in the Army programs prove to be temporary and they can secure new, large-scale contracts from the Department of Defense, it would restore confidence in their core business. Second, successful and meaningful expansion into the commercial sector. Wins like the Nashville Airport and the Washington Commanders are good for headlines, but the company must demonstrate an ability to land multi-million-dollar commercial deals that can be serviced profitably. This is the only way to break free from the lumpy and often unpredictable nature of government procurement cycles. Third, an improvement in gross margins, which would signal a shift towards a more scalable platform-based solution rather than a reliance on low-margin consulting and custom development work. Finally, the broader macroeconomic environment of increased global geopolitical tensions could lead to larger defense and intelligence budgets, creating a rising tide that could lift all boats. Conversely, the bear case is equally, if not more compelling at this moment. The primary risk is continued erosion of their government revenue base. Competition in this space is fierce, not just from direct competitors, but also from the massive prime defense contractors. If BigBear.ai is perceived as a less reliable partner due to execution issues, they could lose out on future bids. The inability to achieve commercial traction is another major risk. The leap from the public to the private sector is notoriously difficult, requiring a completely different sales cycle, marketing strategy, and product mindset. Furthermore, the company's ongoing unprofitability in a higher interest rate environment makes it vulnerable. The market is less forgiving of cash-burning growth stories than it was a few years ago. Any need for additional financing could lead to shareholder dilution, putting further pressure on the stock price. The comparison to an Apple stock or an Nvidia stock is, at this stage, purely aspirational. Those companies built their dominance on ecosystems and clear technological moats, something BBai has yet to establish. The question of whether government reliance is a benefit or a hindrance is central to this stock's entire thesis. I want you to comment below with your perspective. For a company like BigBear.ai, is deep integration with government contracts a strategic advantage or a long-term growth trap? In summary, we return to the profound disconnect between what the market wants Big Bear to be and what its financials currently show it is. The expectation, fueled by a powerful AI narrative and visible on every retail trading platform from Robinhood to SoFi, is that of a nascent industry titan. The reality is a company at a critical inflection point, one whose core revenue stream has shown recent weakness and whose business model faces fundamental questions about its scalability and long-term profitability. Today's strong intraday move is a vote of confidence in the story. However, the data from the last earnings call, the subpar gross margins, and the withdrawn guidance demand a level of scrutiny that goes beyond a cursory glance at a stock chart. The path to becoming a truly successful investment involves translating promise into profit. For BigBear.ai, that translation is still very much a work in progress.